Nation. What's up, guys? Welcome back to the channel. Welcome back to another video. Guys, it's been a very long time since I've made a video, but I'm glad I'm back in it. 400 and some odd days later, here we are. Now, I wanted to start remaking videos and really give you guys something. So I didn't want to just start making videos without a purpose. So for those that are new to the channel, my name is Mark. I'm a full-time trader. I've been doing this for 11 years, and I've been absent from YouTube for about 400 and some odd days. But now I'm back making videos again, and the first thing I want to do is I want to do a quick refresher of everything. So I figured let's go ahead and do a full-blown course on YouTube for absolutely free. So welcome to FXN Trading Group. Welcome to TMM24 Week 1, Trading with Market Makers 2024 Week 1. This whole course is going to be about maybe 12-13 weeks long, and we're going to go into absolutely as much detail as possible on the strategy that I've been using now for 5-6 years now. This strategy, I've back tested it for 7 years. So everything that I show you, I have back testing for, so I know it works over an extended period of time. And that's the important part about this, is that I know that I'm showing it to you because I know that it works over an extended period of time, as I've been doing it now for 6 years. So know that everything that I'm showing you has been back tested and it works. So without further ado, let's get this started, guys, and let's jump in right away into the first thing, which is expectations versus reality. So the first expectation is that day trading is a quick way to get rich. The reality of it is that day trading requires a significant effort and dedication. Successful traders spend years honing their skills, developing strategies, and understanding the market. It's a profession that demands continuous learning and adaptation. Profits can be made, but expecting quick riches often leads to disappointment and rash decisions. There's a huge reason, guys, that over 95% of day traders fail. There is a big reason for that, and this is one of them right there. Another expectation: every trade will be a winner with the right strategy. The reality: no strategy guarantees 100% success. Even with the most well-researched and back-tested strategies, will have losing trades. The market is inherently unpredictable. Success in trading comes from having a strategy with a positive expectancy, meaning over a series of trades, the profits outweigh the losses. Effective risk management is crucial to surviving losing streaks. Guys, I do not care what strategy you're using. There is no 100% win rate in any strategy out there. Any professional trader, their winning strategy is literally 50 to 60% win rate. The main difference that makes them professionals versus everybody else is the fact that they know how to manage their risk. They know how to survive the losing streaks. So always keep that in mind. The next expectation is day trading is glamorous and exciting every day. The reality: day trading involves a lot of routine and discipline. Much of a trader's time is spent waiting for the right setups, analyzing charts, managing existing positions. The excitement of winning a trade is balanced by the necessity of maintaining composure and discipline during periods of inactivity or losses. Day trading is not glamorous at all, guys. I've been doing this now for over 11 years. There's nothing glamorous about day trading. It's actually pretty freaking boring. The next expectation: following market news will guarantee trading success. Market news is only one part of the puzzle. While news can trigger significant market movements, it's often unpredictable and can lead to overreaction. Successful traders use technical analysis and have predefined trading plans. They understand that reacting impulsively to news can lead to poor decision making and losses. I want you to understand this. Successful traders have a predefined trading plan. Keywords: predefined trading plan. How many of you listening to this video right now have a predefined trading plan? And if you do, how many of you are actually following it on a consistent basis? Next expectation: higher leverage means higher profits. The reality: leverage amplifies both profits and losses. While it can increase potential returns, it also significantly increases risk. Many new traders misuse leverage, leading to substantial losses. Experienced traders use leverage carefully, ensuring they never risk more than a small percentage of their capital on any single trade. Guys, the key to you trading on a consistent basis is for you to have actually capital to trade. If you don't have any capital to trade, guess what? You ain't trading nothing. Risk management is one of the most important factors when it comes to how successful you are as a trader. Next expectation: trading is a solidarity activity. Reality is engaging with the trading community can be invaluable. While trading itself might be done alone, being part of a community provides support, shared insights, and different perspectives. It can also help in staying updated with market trends and avoiding common pitfalls through collective knowledge. Guys, let me tell you something. Trading it by itself, okay, you're trading when you're taking your actual trades. I think personally they should be done by yourself, okay, because you don't want other people's influences on what you're doing. Now, it's okay to have a community to have support, ask questions, get different perspectives and stuff like that. But when it comes to actually trading and being in that environment, I believe that you should do that by yourself. Whenever I trade by myself. I'm not trading with nothing on, nobody around me. I don't want to hear nobody else's opinion. The next expectation: you can perfectly time the market. The reality: perfect market timing is a myth. It doesn't exist. Markets are influenced by countless factors, many of which are beyond anyone's control. Instead of trying to time the market perfectly, successful traders focus on identifying high probability setups, managing risk, and executing their strategy consistently. Here's the key factors to this, guys. Identifying high probability setups, managing risk, and executing their strategy consistently. Are you following your trading plan consistently? Because your trading plan should have a way for you to identify high probability setups, should have a risk management plan in it, and also executing it on a consistent basis. The more trades you make, the more money you'll earn. The reality is, over trading can be detrimental. Making too many trades can lead to increased transaction cost, higher exposure to risk, and emotional exhaustion. It's better to focus on making high quality trades based on a well-defined criteria rather than chasing every potential opportunity. I don't know about you, but every week, okay, when I look at how many trades I've taken, I normally take maybe 3 trades a week. You have to understand that not every day is going to be a trading day. Not every day deserves to be a trading day. And so it's up to you to have a better focus on making high quality trades based on the defined criteria that you have in your trading plan. Automated trading systems will make you consistently profitable. Automated systems need regular oversight. While they can help in executing trades more efficiently, they are not foolproof. Market conditions change and systems need to be updated and monitored. Relying solely on automation without understanding the underlying strategy can lead to significant losses. Day trading allows complete financial freedom. The reality is, guys, day trading requires consistent effort and vigilance. While it can offer more flexibility than a traditional job, it also demands daily dedication through preparation and mental resilience to handle stress and uncertainty. True financial freedom in trading comes from a long-term, disciplined approach rather than short-term gains. This whole thing that you're trying to do right now, takes time. Forget about all of your freaking entertainers on YouTube that are showing you Lamborghinis and money. This, to become financially free from trading, it's a long-term commitment. When you want to become a doctor, you got to go to school for how many years? When you want to become a lawyer, you got to go to school for how many years? You want to be a surgeon, you got to go to school for how many years? Any kind of true profession, you have to go to school for X amount of years. This is no different. I truly believe that trading is probably one of the hardest professions that you could ever do, because it literally will test absolutely everything about you: your emotions, your mental state, your discipline, and your consistency. All right, so now that we got through some of the expectations versus realities, let's get right into this course. So the first thing that we're going to talk about this week is going to be market cycles. So let's jump right into it and talk about these market cycles. Now, market cycles. The market cycles provide you with your directional bias. Why is that important? Well, if you have a directional bias, it helps you eliminate the possibility of going in the wrong direction, right? So market cycles that we're going to talk about today provide you with your directional bias on which direction you're trading for that day. This works on any market: Forex, indexes, and commodities. These market cycles have been back tested, and I've been doing them for several years now, over 5 years, on Forex, index, and commodities. So I know they work and you can identify them. Market cycles are based off average daily ranges. Okay, we're going to get into every detail about this throughout the video and throughout the course, so just hang in there with me. But just understand that the market cycles are based off of the average daily ranges. Every pair has a daily range that it goes through. Okay, ideal market cycles are 3 times its own ADR. All right, so if a pair moves, if EURUSD on average, let's say, moves 100 pips a day, that means that a cycle should last somewhere in the range of about 300 pips. That's 3 times its own ADR. Based on 7 years now of backtesting, this 3 times ADR has to be adjusted because market conditions have changed. So with that being said, market cycles can range anywhere from 2.5 times ADR to 4.5 times ADR. Okay, so the perfect cycle we want is 3 times ADR, but the conditions have changed over the years, and so now we're looking at anywhere from 2.5 to 4.5 times ADR for one cycle. Every cycle has a different ADR. So meaning that if you have one cycle, okay, one market cycle, let's say that's, let's say EURUSD averages on this cycle 100 pips a day. So let's say it goes down 300 pips and then it reverses. Okay, the next cycle that's going to be created might not be 100 pips as the average. So the next cycle might be an average of 75 pips, and so it's 75 times 3. Or it could be 125 pips per day. Okay, basically 125 times 3 at that point. So just keep in mind that every cycle has a different ADR. The average market cycle is about 10 to 14 days. And finally, the market cycles are measured on the 1 hour time frame. I'm going to show you how to do all this stuff. Quick recap. Market cycles give you the daily bias. It works on Forex, index, and commodities. The cycles are based off of the average daily range. The ideal market cycle is 3 times ADR, but the average and the range is anywhere from 2.5 to 4.5 times ADR. Every cycle has a different ADR. The average cycle is about 10 to 14 days, and the market cycles are measured on the 1 hour chart. Okay. Now, every market cycle begins and ends with a peak formation. Okay. Peak formations are just simply the turning point of each cycle at the beginning and at the end. Peak formation high of the cycle is basically the very top of the cycle, and peak formation low is basically the bottom of the cycle. A new peak formation is confirmed using these rules. Okay, so these are the rules that determine how we get a new peak formation. So first thing, the ADR. It's got to be in the range of 2.5 to 4.5 times ADR. Second rule, you must have a 1350 EMA crossover on a 1 hour chart. Third rule, you must have a 1 times ADR move away from the new peak formation high that was just created. So meaning that price action must have moved at least 1 time its own ADR. So EURUSD, let's say, for example, created a new peak formation low. Well, that peak formation low from the very bottom to where price action is must have moved at least 1 times ADR away from that new peak formation. And finally, price action must break a previous structure. Okay, these are the rules for confirming a peak formation. I'm going to show you this on a chart. All right, just follow me here for a second. All right, so what do the cycles look like? What does the cycle look like? What are we talking about? All right, so here's the cycle right here. This is pound USD. You can see from the bottom left, peak formation low is there in the square, and it goes all the way up to peak formation high when it reverses. That's basically what a cycle looks like. Notice how many days this particular cycle is. About 2 weeks, 11 days or so, give or take, 11, 12 days. Here's another one. Also pound USD, same scenario. I see peak formation high on the left, peak formation low on the bottom, okay? Notice how many days this one is here. It goes from Thursday through an entire week and then ends on a Tuesday. Here's another one. Again, peak formation high to peak formation low. Again on pound USD. And this one is almost 3 weeks, okay? So that's what a market cycle looks like, going up or going down. Now, let's talk about market resets. So what the heck is a market reset? So market resets occur when markets aim to exceed 3 times ADR in a single direction. So let me just give you a hypothetical. So let's say that the market wants to move 600 pips in one direction. Let's say the market wants to sell off 600 pips, okay? And let's say that EURUSD, it's averaging about, let's say, 100 pips per day, right? So in this example, basically, you cannot go down 600 pips in one cycle, okay? Cannot go down 600 pips in one cycle because we know typically it's anywhere from 2.5 to 4.5 times ADR, right, for one cycle. So what happens is market goes down one cycle, let's say 300 pips, and then it looks like it's going to reverse, okay, for a new cycle. But what ends up happening is that instead of going back up again, it continues and it breaks through the peak formation low that it just created, okay? And then now, essentially, that becomes a reset of the market, and then now they can go down another 300 pips to complete the 600 pip move, okay? I'm going to show you all this on a chart so you know what it looks like. A valid reset requires breaking the previous peak formation that has just been created. So just like I talked about, resets do lead to a new creation of a new peak formation. So basically it'll create a new peak formation and demand a new full cycle. So as soon as you get a reset, you can expect another full cycle to come out of that. Okay, so you won't have a market reset without getting another full cycle out of it. And then this new cycle will follow the same principles as any other previous cycle. So the same rules still apply to this new cycle. So what do resets look like? Well, here's one right here. Here's peak formation low to peak formation high, and you can see price action came down like it wanted to reverse, and come back down again. But obviously you could see what happened. It immediately reversed and continued to go higher. So that right there is the reset. And then, like I said, it creates another brand new cycle. So here's 2 cycles. You can see it took 1, 2, 3, about 4.5 weeks for 2 cycles. This is again on EURUSD. Here's another one. This actually has multiple resets. So you can see starting from the top left, peak formation high to peak formation low, reverses, but then immediately comes down, breaks through the previous peak formation low, creates another cycle, goes back up again, and then resets again. So this one actually gave you 2 resets. So you had 1, 2, 3 cycles on this example. Now let's talk about failed resets. So what is a failed reset? So a failed reset occur after a new peak formation has been established. They're characterized by price movements that go back to retest the new peak formation. So essentially what happens is you get a new peak formation, right? Either peak formation high or peak formation low. Let's just say an example, you get a peak formation low. Price is now going up, okay? But what ends up happening is instead of price continuing to go higher on a new cycle, price reverses because it wants to retest that new peak formation low that was just created in order to grab orders before continuing on that uptrend. So failed resets do serve to accumulate the market orders needed for the price to advance in that new trend. Failed resets can happen when price action consolidates after forming a new peak formation, resulting in several peak formations and failed resets in the same area. I'm going to show you what I'm talking about so you don't feel lost right now. Here is what a failed resets look like. Basically, you could see peak formation high goes down like a normal cycle, but then comes back up to retest the previous peak formation. And you can see this here multiple times where it's done it 1, 2, 3 times. Okay, so every time that it goes back up to retest the previous peak formation high, all it's doing is just grabbing orders. That's why it's not moving down like it normally would on a regular cycle, because it's just waiting for traders to come into the market to place orders so they can grab those orders and then move away in the directional bias. If you look at the third peak formation high to the right here, you could see essentially just how much they grabbed orders here as price action went a little bit higher. You can see the last peak formation high on the right went higher than the previous two. Those are orders sitting up on top of those other previous peak formation highs. So as soon as they grab those orders, you can see at the end there how aggressive the move down was once after they got those orders. Here's another example of failed resets. You can see peak formation high, failed reset, peak formation. It just consolidates back and forth. And then as soon as they have enough orders, you can see it moving straight down, reset, boom, keeps going for another cycle. And then here is an example of everything all at once. So peak formations, resets, failed resets, peak formations, failed resets, going into a reset. Look at the last examples here on the right. You see a peak formation high going down to a failed reset, comes back up to retest, create another peak formation high, and then immediately resets after that. So these are cycles right here, guys. This is how the market moves with these cycles. You're going to know how to do this, by the way. You're going to know how to do this by the end of this course. You may not be perfect at it, but you're damn sure going to know how to do it. So now let's talk about super cycles. What is a super cycle? Super cycles. These cycles extend beyond the typical range of regular market cycles. Okay, so we talked about how market cycles typically go from a range of about 2.5 to 4.5 times its own ADR. Okay, super cycles basically go well beyond 4.5 times ADR. So these cycles will specifically occur in JPY pairs, indexes, and commodities. They only happen on these specific assets. All JPY pairs, indexes, and commodities. Okay, the super cycle can go well over 4.5 times ADR, and I mean, when especially like on these JPY pairs, I've seen them go 8-9 times ADR in one shot. And a lot of times what ends up happening is that JPY pairs, they end up running like nonstop because of how weak the currency is versus the dollar, versus the euro, versus the pound. Japanese yen is just a really weak currency. So these super cycles, they allow no opportunity for a reset to take place. So what I mean by that is that you basically have no opportunity to break the cycles up into two cycles. Okay, so there is no reset, nothing. It just literally just keeps going. These cycles typically occur either because of economic events or markets looking for higher time frame orders. So meaning, if you look on, if you're looking at it on a 1 hour chart, if you skip over to daily, weekly, monthly charts, you'll see that there is absolutely no price action to the left to give any kind of due course for the price to stop. So it's just continuing to reach until it goes and grabs the higher time frame orders. So here is what a super cycle looks like. Here's two of them back to back. This is Euro JPY. You can see from peak formation high to peak formation low. This one here was about 8.5 times ADR on both. Here it is on gold. Here it is on SPX 500. So S&P 500. Here's that one. And again, you can't. The reason that they're called super cycles is because you cannot break them up into two cycles. You don't get you don't have an opportunity that meet all of the rules for breaking it up into two cycles. All right, so now let's go ahead and jump into the charts, and let me show you how to break down these market cycles, how to actually draw them out so you can start doing this yourself. All right, guys, so now that we're on the charts, let's go ahead and show you literally how to break this market cycle down in the simplest form for you. So what we're going to do first is let's just go ahead and pick out on EURUSD, simplest, most traded, obviously, pair out there. So let's get right into it. And what we're going to do first is we need to figure out what the ADR is for this pair. So what we're going to do is very simply, we're going to go to the indicators, okay? And I want you to type in the diddly is what I want you to type in. And you're going to pick this one here, Diddly Charts by Rob Minty. Okay, and then from there, you're going to type in FXN, and then you're going to put in the buy or sell signals. That's just basically the EMAs. All right, once we have all that put on the charts, what we're going to do is we're going to go over to the FXN buy sell signals. We're going to click on the settings. And all we're looking for to do is we're just going to uncheck everything except for the 50 and the 13. Obviously, we're going to use those for confirmations of peak formations. Now, if we go over to the diddly charts, we're going to go into the settings of those. And what we're going to do first is we're going to check mark this 1 hour chart here. And then we're going to scroll down to where it says text size here for small. We're going to make it normal, and then go down here to where it says retain historical labels, and we're going to move that up to about 21 days. So that way it reads out the ADR for the last 21 days. So with that being said, let's get right into it. I'm going to go ahead and we're going to do, let's say, from this area here all the way to current price action. So I'm going to go into replay mode here so we can just get this one section done first. Okay, and we can really focus in on this one section only. Looking at this one section, the first thing that we can easily do, okay, is we can obviously identify the peak formation high, which is here. This is the first turning point, okay? So we can go ahead and put the box around here, and then I'm going to start labeling stuff so that way it's easy for you to see. So that's peak formation high. All right, so that's the easy one. Right now, we need to figure out what is going to be the ADR for this pair. One last setting on the daily charts is display ADR historical labels. Make sure that that's checked also. That's also under the 21 that we just selected. Okay, that'll make sure that it's actually activated on 21 days. So here we go. We can go ahead and see that the average ADR in all these days is somewhere around 63, 65, 66. 65 range. Okay, 65 range is the ADR that we're working with. Okay, so let's put that down here so we can work with it. So 65 ADR. And then what are our rules for peak formation highs and peak formation lows? Here are the rules for the peak formation high, peak formation low. Okay, so now we have them here so we can all look at them. All right, so if we have a peak formation high here and we are averaging somewhere around 65 as the ADR, then 65 times 3 is going to be somewhere in the range of about 195 pips. So if we take the measuring tool and we start measuring from the very top, this is wicks included, okay, from the very top of the peak formation, and we start to work our way down. Remember that the average ADR that we're looking for is about 195. So you can see just by coming straight down here to this wick here, we're already at 263. So what is 263 divided by 65, which is the average ADR? That right there is 4 times ADR. So is 4 times ADR within the ADR range? It is, right? Also, did we get a 1350 crossover? Yes, we did. And then did we move away 1 times ADR? Well, if we measure from here to here, yes, we've moved well over 1 times ADR. And then did price action must break a previous structure? So where is this previous structure? The previous structure that we're talking about is basically this right here. This is the previous structure. So did we break it? Yes, this broke it here. So this meets all of the qualifications, right, for a peak formation low. So we'll move this over down, and then we'll relabel this peak formation low, and that's the first peak formation low. Now, what happens here? Price goes up, breaks the structure, and then immediately comes back down again, and it continues to go down. So what does this mean? Well, that means that this right here is obviously a reset. Okay, so this is a reset here, and again, because it's a reset, it does become a new peak formation high. So I'll just put peak formation high reset, and then we start over from there. We're still working with our 195, pip range or whatnots. Okay, so as we keep moving down, you can see here we're again at 221 right here. Okay, now again, same rules, right? Let's bring these over here. Same rules apply. If we measure it out from the very top of the wick down to the bottom here, it's 219. So obviously we already know that that's well over 3 times ADR, and it's within our range of 2.5 to 4.5 times ADR. So that's been met. Did we get a 1350 cross? Yes. Do we have a move of 1 times ADR? Obviously, yes. We're going to have that move if we measure from here to here. It's well over 60 pips. And then price action must have broken previous structure. Yes. The previous structure that we're talking about would have been this here. Yes, we broke through it. So that meets all the requirements for a peak formation. So there's another peak formation low here. We can obviously see, you should already see, price action went up and immediately came down and started to go down again. All right, so obviously this is going to be another reset and another peak formation high. Okay, we keep going down, and now we measure this and we start going down. Here we're already at 201. If we're looking for 195 as 3 times ADR, obviously that's going to be enough for a full cycle. Now the question is, let's play this out a little bit more, is does it meet all of the requirements for a peak formation, right? So obviously we're in the range, 1350 crossover that happened here, 1 times ADR. If we measure it, obviously it's already moved 86 pips, so yes. And then did price action break the previous structure? In this case, the previous structure is this right here. Yes, it broke it. So that is a new peak formation low. So that right there is another peak formation low. And then obviously now you can see we're going higher. So let's play this out real quick and get another bunch of price action going here so we can continue to count this. Notice how this cycle here, remember I told you not every cycle is the same as far as ADR goes. This one here you can start to see it's 62, 63, 60, and now we're getting into the 57s or so. Okay, and so if we're already aiming towards in the early 60s, that we're going to be looking for even a smaller ADR, which is 63 is about 189 pips or so. Let's go ahead and start measuring out here. So from the peak formation low to, let's say, to here is about 171 pips. So is that enough? Well, if we take 171 and you just divide that by the 63. That gives you 2.7. So yes, that is enough for a full cycle. Now the question is, do we get enough of everything else? Does everything else qualify for peak formation? So we have, obviously we have enough for between 2.5 to 4.5 times ADR. We have the 1350 cross, which that happened here. Did we go 1 times ADR? We went 66, 68, so yes. And then did we break previous structure? The previous structure in this case would have been here. And did we break below it? Yes, we broke below it. So that would be another peak formation. So here we have another peak formation. And then what happens here? Price comes down and then immediately reverses. So what is this? This is going to be a reset. So this will be a new peak formation low, reset. As we start to get into this next cycle, notice the ADR, right? Notice the ADR change. Let's get close and you'll start to see now it's in the 54s, 48s, 50s. So we're right in the 50, give or take 50 pip mark. So now we know obviously 3 times ADR for 50 is about 150. So if we go up here, you could see we're at 186. So we definitely know that that is going to be enough for a full cycle. So this is going to be another peak formation high here. Let's talk about the requirements. From the top here, did we move down 1 times ADR? We did. We're over that. We had the crossover. And then did we break the closest structure? The closest structure in this case here is going to be right here. The closest structure is this. So did we break it? Yes, we broke it. So this is a peak formation. Now, I want you to notice what happens with price action, right? What does price action do here? Price action doesn't go down. It actually goes back up and retests that high. But then what happens after that? It now goes straight down. So what is this called here? How do we do this? This right here is basically a failed reset, and then obviously this becomes another peak formation high. So now we have a peak formation high. Obviously same thing, crossover, we broke the structure, and obviously we went past well below 1 times ADR on this. So now let's just play it and notice the ADR is still hanging around the 50 mark, 49, 50. So it's the ADR is still the same for this specific cycle, which is about 50. So we're looking for, let's say, somewhere around 150. Okay, so if we measure out 150 from the peak formation high and we go down, we are at 130. So if we take 130 and divide that by 50, we get 2.6. So that is enough for a peak formation low. So this right here is going to end up being another peak formation low here. Obviously we had the crossover. We have enough between 2.5 and 4.5. We obviously went well over 1 times ADR, and then we break the previous structure. The previous structure is right here. Yes, we broke it, obviously. So that is a peak formation low. Now, obviously, look what happens here again is we go up and then immediately come back down again. So what is this going to be? This is going to be a reset and a new peak formation high. We start looking at the ADR again. We're in the 50s, 53, 52. Let's keep this going here and just see how far low it goes. If we're looking for in the 50s still, we're looking for, let's say 52 is a new average. So we're going to be looking for about 156 pips or so. So if we go ahead and mark down here, here's 142. So 142, divide that by, let's say 52. That's 2.7 times ADR. Okay, that is actually enough for a full cycle. Did we get a crossover? Yes, we got a crossover here. And then did we break? We obviously went 1 times ADR. If we measure this, yes, we went 1 times ADR. And then we broke previous structure. The previous structure would have been here. So this is another peak formation low. Again, look what happens as soon as you cross over, immediately continues down. So obviously this is another peak formation high and reset. So now the ADR is pretty clear, 52, 52, 52. So we're looking for still 52 times 3, about 156 pips. And you can already start to see here that we've already gotten a crossover. So let's measure this out from the reset here, peak formation high coming all the way down. It's 138. So 138 divided by 52, that gives you again 2.6 times ADR. So obviously that is enough for a full cycle. We had the crossover and we broke structure as well. So all the components are there again for another peak formation low. The structure in this particular case here is down here, is this structure down here. Obviously we know we went past 1 times ADR, we had the crossover, so all that there is good. And so now let's take a look at the ADR, 53, 55. So now we're going up by 2 pips or so on this ADR. And if we go from here all the way up, that's 153. We already know that's going to be enough for a full cycle there. So here is another peak formation high. Same rules. Let's move the rules over here. We had the crossover happen. We had 1 times ADR. Yes, we broke the structure. The structure in this case was this right here. Yes, we broke it. So yes, this meets all the requirements. So now let's just keep going now. It's very important. Just pay attention to what price action is doing. And then now you can see basically how we came down, but immediately went back up to retest that previous peak formation high. So what do you think that is right there? If it did that, right? We did that before already. So that essentially means that this is a failed reset. This is another peak formation high. Now notice the ADR on this cycle went from 52. Now we're into the 56, 57, 58. So the ADR is going up now as far as the range goes. So if we're going up, let's say we're sticking to, in that particular range of 57, 58, 59. So let's just say 57. We're looking for somewhere around 171 pips. That's 3 times ADR. So notice how we just had a crossover after a major pull. So let's go ahead and start to measure there and see how much we have. So 284, clearly well over, enough for a cycle. So that's going to be a new peak formation low there. Obviously the structure that it broke was here. That broke it. Obviously we were well over 1 times ADR on that as well. Crossover. So all the requirements are there for a peak formation low. That's going to be another peak formation low there. And then now notice the ADR on the next cycle, we're starting to get into 59.60. Okay, so the 59.60 range, that's about 180. Okay, so we're looking for about 180 pips move in one direction, at least. Look where price is right now, and we're about 152. That right there is about 2.6 times ADR. Okay, so we do have enough here for this to be another peak formation high. And then you can see what happens. The structure that we broke was obviously here, broke it, and then immediately went up again. So we know that this is a reset. And reset, new peak formation low basically. Now notice the cycle here is gone up now. It's 64. Okay, so keep that in mind now, 64. So 64, now we're looking at somewhere around 192. So let's measure this up here first. So 192, this right here is about 160. If we do 160, That is exactly 2.5 times ADR. So we do have enough for a full cycle here. Now, the question that some of you might be asking is, why not go from here to the very top? Okay, why not do that? Well, you can do that if you want to, as long as you're within the range. So it's 244, right? And then let's say we're averaging somewhere in the 63 range. It's 3.8 times ADR. So if you wanted to, you could go all the way up here, okay? And this could be your peak formation high. Okay, you could totally do that if you wanted to. You can call this a peak formation high, okay? Because from here to here is, 3.8 times ADR. Now, if you were to break it down from here to here, and you're only looking at that because you had a crossover, is really the main point here. You had a crossover, you had 162 pips, and then we're still averaging 63. So this is 2.5, this is enough. So what would end up happening is basically you could break it up again here into a peak formation high, and then essentially what you'd end up doing is this would end up being another reset. Either way, and if we even measure this out again here, right, this is 172. So 172, and we divide it by, let's say 55, you still get 3 times ADR. So no matter if you go from here or all the way over, you're still within the range. So no matter what, you're still getting the same outcome. And that's the important part, is that no matter if you're doing it this way or another way, you're doing it a whole from 3.8 and not breaking it up into 2, you're still getting out to the same outcome. That's the important part about all this. So let's get out of replay mode real quick so you can see the rest of the chart here. And then now we could just do the rest since we have the entire chart here. So now you can see this here is around 52. So we're back down to looking for about 156 pips. So if we come down here, clearly that's not enough. You can see price action goes back up here again. So this is going to end up being a failed reset. This is going to end up being another peak formation. Now immediately you can already see this comes down and then goes back up again. So this is going to be also another failed reset. The reason that it's a failed reset, okay, is because if we measure this from the top to the bottom here, you can see the ADR is 48 and this move is only about 100 pips. So we know we're short for a full cycle. So that's how we know that it's going to end up being a failed reset. And it goes back up again, and you can obviously see it goes straight down after that. So this becomes peak formation high. You could see essentially that this peak basically took out orders that were sitting on top of these two previous highs and then immediately dropped. Okay, so now that we're here, let's finish this off. Peak formation high. The ADR here is 48, 49, going into 50. Let's just use 50 to keep it simple. Going down to 195, obviously that's going to be enough for a full cycle. So this becomes a peak formation low. Obviously price goes up and then immediately reverses. So we know that this is not enough for a full cycle anyways. This is going to end up being another reset. And then now we're looking at 56, 57. So let's see what we got from here. About 183 pips. And we were averaging, let's say 57. That right there is 3.2 times ADR. So that is enough also for a full cycle. So that is peak formation low. And then we're pretty much caught up where price action is now. So we're coming off a peak formation low. Obviously the bias right now would be to look for buys. You just saw me break down an entire chart going back from December. So from December all the way to current price action, we just broke down an entire chart. Obviously when you first start doing it, if you've never done it before, you're not going to be good at it. You're going to suck at it. Just like whenever you first started trading, you sucked. You didn't understand what a pip was. You didn't understand what margin call is. You don't understand anything, leverage, nothing, right? You didn't understand how to read the candlesticks, nothing. And that's okay, all right? But mapping this out will give you an advantage because this is what gives me my daily bias. So I know what I'm looking for. Okay, so I know that if I'm looking for buys only, all right, I'm not worried about what patterns happen here that are not buys. this is how you break down a chart. If you want to do this for homework, what I would strongly recommend is take a chart and then just literally do what I did. The more that you do it, the better you'll become at it. Okay. This is only week 1. We're going to talk about this throughout the entire course. So be patient as we build on the upcoming weeks. We're just going to keep building on this, and we're going to start to put everything together. The entries, exits, patterns, everything. All right. You're going to know exactly everything that I know. That's in my head. I'm going to put it into the video so that way you know, and you know exactly what I'm doing. All right. So guys, I hope you enjoyed this video, and we'll see you in the next one.